So we got all-time highs across multiple indexes today. How does that impact our market posture? We've been strongly bullish, showing a little bit of weakness and bearish. We've been getting this short-term bounce with expectations that it wouldn't go up too high. What did today's move just blow that out of the water, and now we're back on that bull train? Or is there some caution to be? So I'm going to break down some technical indicators to see kind of what if our expectations have changed. And then with today's trade idea, we're going to look within one of the strongest sectors we've had in this bull market, at least on the U.S. front, and see if we can take advantage. So let's go ahead and get started. Today is Tuesday, November the 21st, 2017. My name is David Settle. This is my market outlook for today. Welcome. Thank you very much for watching today. Welcome to those that are watching for the first time. Welcome back to those who may have taken a hiatus from us. Subscribe to my YouTube channel. Hit that red button down below this video. Hit the thumbs up. Let me know that you found today's video useful with one click by clicking on that thumbs up indicator. Scroll further down, click on the comment on anything that stood out to you from today's video. You'll see in the description of the YouTube video a link to join my daily email newsletter. So click that link and subscribe to that email list. You'll also see a link to like today's market outlook video on Twitter and on Facebook. Those links will take you straight to those accounts. Remember, on Twitter, you can follow me for more content in addition to these videos. My handle's on the screen, at DavidSettle42. Pinned to the top is today's market outlook tweet. Like and retweet that so other people, if you feel like other people should check it out. When you retweet, you have the option to comment and tell people why they should check it out. And I appreciate everybody who does that. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator, see what's going on here today with the rally up to new all-time highs. Now, if you recall, we talked about the idea that we could go up to slightly new higher highs. That's not a surprise. I would be surprised if we go up to significant new higher highs. Doesn't mean that that can't happen. Of course, anything can happen, especially whenever there's a catalyst that's coming out, like the tax reform bill, which is driving a lot of this action. The S&P 500 finally catching up to what you're seeing in the Russell 2000, and this is all tax reform related. It took a few days, but small cap, that's kind of bleeding its way into large cap stocks too. Obviously, small caps are benefited the most. You notice what's not going up very much yet is this near-term line. So it almost looks like a cluster here, but the problem is it would be a cluster if all three lines had to be above 70, but that's not the case, because you see how they're all 72, 73, 73. They need to all be above 80. So that near-term line did jump up today, which, not surprising. The momentum line jumped up today, which is not surprising, again, considering the update that we've had. But neither one of them got up to, new highs. So remember, we've been on the bearish posture, weak bearish posture, but a bearish posture. When you're looking for posture changes that will be significant, you look for a couple of signs. Number one, the momentum line to get to an extreme high point. Again, we're looking for a trend change to the upside here. You look for the momentum line to get up to an extreme high point. That's defined as anything above 90th percentile. Extreme low point, it would be anything below the 5th percentile. So we're not above the 90th percentile, number one. Number two, the other second sign you look for is that blue line to get above 80. To get into that reversal zone, and something like this, not just like dipping its toe in the water, so to speak. And obviously that hasn't happened yet either. So while yes, today's a great day, and we did get up to a new all-time closing high on the S&P 500, that short-term sentiment still doesn't suggest that we're going to be bullish now for the next little bit. Because in reality, remember, we haven't really been bearish. That the intermediate posture got below 80, reflects a weak bearish posture, but never got below 50. It's got to get below 50 before you expect multi-month runs. Here, we got above 50 again at the end of August. We're going now on almost 3 months of this bullish run, even with this little weak pullback that we've had. So, again, grain of salt on this bounce, and market sentiment still above 90. Well, actually now it's below 90. It's falling from above 90. Those two factors suggest if we do get a upward move, it's not going to be like this, where we got an upward, we broke up to new highs, bounced down, and then, near-term bounce down and retested and then moved, right? We don't, this pullback here isn't enough of a pullback to have brought either the intermediate line below 50 or the market sentiment line down to even, in this case, at least it's to below 70. We haven't had either one of those cases, so don't expect this kind of move here to come out of this. Expect more of a quiet, maybe grind, especially with the holiday tomorrow and Friday. Now, there's going to be a lot of economic data in the morning, so it might be a little bit volatile in the morning. But as we get in the afternoon, volume's going to dry up like crazy. And then Friday's volume most likely will be pretty light too, considering it's a half day. So it'll be Monday. And there's a tweet I saw out there that said that the market's usually higher today or tomorrow, the day before and the day after Thanksgiving, like a really high percentage of the time, but it's also lower a high percentage of the time that next Monday. So we might grind a little higher tomorrow, Friday. Mondays, we'll keep our eyes to see whether or not, what any kind of pullback, if we get one, of course, because seasonality doesn't guarantee anything. But if we get that short-term pullback on Monday, how far it brings short-term sentiment down and what that does to the posture. We saw the Russell 2000. Look at that near-term line. It's as high as it can almost get. It's 99th percentile. The intermediate posture obviously is above 50. Again, see, this pullback brought the intermediate line down below 50, but it didn't bring market sentiment line down. It stayed up above 80. So again, not the sharpest, not enough of a exhale to say, that we're going to get this kind of inhale coming off of these highs. And again, all-time high, strong move. A lot of it is tax reform related, so we'll see, if that continues, if there's positive momentum on the fiscal front, then throw technical analysis out the window. The markets will respond to whatever the news it gets, right? So, and we've seen what the market will do, on that reform news. So the more and more that momentum builds, the more and more the market likes it. Now, eventually there'll be kind of a sell the rumor, buy the news. When and if that tax reform actually gets put in, you'll probably see a little bit of a pullback because of that. Again, buy the rumor, sell the news, kind of a phenomenon. But until then, right now, we're buying the rumor. The rumors, the tax reform is still a rumor. It's still not, signed and implemented. And so until that happens, you've seen how the market's going to react. And as long as that momentum continues, then that can throw any of this kind of technical and overbought and mature bull market technical analysis thrown out the window. The long-term chart, you can see, continues to be, that was our pullback to the 50-day. We've seen that a few times, and now we're kind of bouncing off of this. And as I mentioned before, while we are in a mature bull market, there's a great tweet out there. Here's a really good read. If you want to check this out, again, I'm at David Settle 42. Scroll down. You don't have to scroll down too far, but you'll see that chart. An old bull market, but still healthy. It doesn't mean that we can't get a correction, but any correction wouldn't be trend changing. Because again, and I'll reiterate this, trend changing corrections don't occur when the gap between the 50 and 200-day moving averages is that big. But it doesn't mean that we can't pull back to the 50. Doesn't mean that we can't pull back below the 50. But we usually won't pull back to the 200 until that starts to drop. The MACD starts to drop, and we won't really break the 200 until we're a lot closer to zero. Doesn't have to be at zero, but a lot closer to zero. That's when we'll really break it and stay below it, right? Stay week after week below that. The 3 green arrow chart, you can see, is almost back to 3 green arrows. We're back above the moving average. It's still rising. The MACD is the one that doesn't have a green arrow yet, but it's close. And the stochastics has a phantom arrow, like the posture on the S&P is turning back up. Remember, weak bearish back to strong bullish. It doesn't go weak bearish to weak bullish, or strong bearish or strong bullish to strong bearish, right? It's one to the other. So strong bullish, weak bearish, back to strong bullish. If you're strong bearish on the posture, you turn up, that's a weak bullish. You turn back down, immediately it's back to strong bearish. So just remember that you never go from strong bullish postures to strong bearish postures, or weak bullish postures to weak bearish postures. It's the opposite. So we have been strongly bullish, we've been weakly bearish, we've turned back up, we're back to strongly bullish again, or at least getting there because we're already so high. And you can see, again, you can even see here the lines all in order. back up above the 8-day moving average, sharply back above the 8-day moving average. MACD back up to that line. I wouldn't be surprised if we get a little bit above it. But I still think this grinding is still making its way back to zero. So watch for, you know, a holiday kind of grind, getting that MACD a little bit above that. But you can see when you make that grind, here, let's go back to some other grinds. When we come down, you can see when you make that grind down to zero, you can still go up. That MACD can go up above its line. We can even go up to a slightly higher high, but then you get the grind down lower, right? And you can see a lot more volatility in May and June. So that's kind of what I'm talking about here, is we can go up above that. We can even go up to higher highs. I mean, we've been talking about that last few videos, but that doesn't, because of how high market sentiment is, because of all these divergences that are potentially setting up on both the MACD and the stochastics, I wouldn't expect it to last too long and be too significant. You know, you even see back this example lasted about a week, a strong week, and then it corrected. Didn't correct significantly, so again, it's not like a correction can cause a long-term bearish move, but it corrected, and we went sideways and had a couple of months of volatility before you had an upward move again. So when you look at today's range, it was a relatively small range, but remember, you have to include the gap, and you can see we broke above the 4-week high. So you remember how we talked about how we were going to raise up, you know, one more day we're going to raise this up to here. We need if we're going to stay bullish and not have, you know, not expect a more significant bearish move, we don't want that range to tighten up. So it's a good thing from the long bullish trend perspective that we've pushed up the 4-week high point here a little bit today, because again, tomorrow the 4-week low is gonna move up significantly, and then it'll be there for a few weeks. It'll be at that low point before we move it up again after that. So we'll have some time. Even if this ends up being the peak, we'll have some time for it to grind a little bit before, if things ever were to turn lower and have any kind of correction. Look at the daily range and the volume. The volume picked back up, 68 million. The range again was 2 points. If you take a look at the gap, so the gap, we closed at 258.30. The low today 258. Oh, we came down to that low. So there's our range, 2-point range on 68 million, just a little bit above average volume. So 68 million volume is right there. 2-point range is very high. So that's a sharply high move. Don't expect more like that, because that would be bearish if that's the case. We want more moves like this one. We had a strong move there, then we followed it up with some small grinders. Expect small grinders, especially because of the Thanksgiving holiday coming out of that with a really, really light volume. Again, barring any other news, because any kind of news can throw that expectation out the window. But considering the holiday, considering what we got today, again, it seems like we pulled forward a few days, you know, this Thanksgiving holiday, we pulled forward some bullishness into today. So I wouldn't be surprised if we're really flat tomorrow and Friday. And then Monday, we've seen again in the past, typically can be a little bit of a bearish day. We'll see how that impacts. We'll see if it's bearish enough to impact this current bullish posture that we're on right now. And if you take a look at volatility dropped like a rock. So I got to move this even down further, all the way back down below 10 on an absolute basis. On a relative basis, you can see volatility dropped way down into that extreme level. So, you know, again, that's kind of lining up. But we'll see if Monday ends up being the day that we get a little bit of a bounce back. But you can see how right now volatility is getting extremely low again, extremely low, heading into what can be a quiet week and hold volatility down, a quiet weekend that can hold volatility down here until next week, the first full week. And then we start heading into that Christmas holiday season. Typically a very bullish time of year. We'll see if that ends up being the case. If it is, we're going to hang around here. And it's going to be a very boring December, which will be a good thing for the bullish trend. It'll be a bad thing if you're trying to trade aggressively, speculatively. It'll be a good thing if you're just kind of selling premium and letting the market just kind of grind its way around. So from a news perspective, from a calendar, you can see, we still have some earnings coming out. The Fed national activity, it's kind of a summation of all those manufacturing surveys. Existing home sales came out. They bounced back up, so that kind of follows through on that really strong new home sales report that we've had. From a broad perspective, all these economic indicators still looking really, really good. Very strong. Stronger than we've seen in years, at least without QE, right? This is the strongest we've seen without any kind of help. Now, the last couple of spikes have been on fiscal reform, immediately following the election, and now with the tax reform bill coming out, it's been very reform-related bullish sentiment, and it hasn't quite shown up yet in strong economic data, strong growth. We'll see as that continues. Tomorrow we'll get an update on the GDP estimate. But we do see now, because of how strong the sentiment is, at the very least, here, the odds now of 2 rate hikes by next June are higher than not having any at all. So the purple line is, so again, we are going to get a hike. According to the futures market, we are going to get a hike in December. After that, the odds, here's the odds of getting one in December. This is all by June. One in 2018. Now the gray line is getting 2 in 2018. The purple line is not getting any in 2018 by June. So you can see that there was a time here just a couple months ago that the odds were higher that we wouldn't get any rate hikes in 2018 than any of these others. But it was early in June. And you can see that the green line in early September was we wouldn't even get a rate hike in December. So no rate hikes at all. That was the highest odds. So none in December, none in March, none in June. That just dropped like a rock, and now we are expected to get one. And then you can see how the purple line of just having one started to drop in the late part of September, and now we're getting pretty decent odds of getting even 2. So strong odds of, and again, that's going to impact the yield spreads. And I tweeted this out today too. There's a lot of chatter about the yield spread falling, and that was significant during the QE era. When the yield spread was falling, the Fed was really trying to keep rates down, especially on the long end down. So when the yield spread was falling or flattening, then the yield curve was flattening. Then the Fed came out with QE2. They came out with QE3. They needed to get that spread higher because they wanted banks to be able to take advantage of that gap. Now the yield spread's falling. We're not in a QE era. The market's not tanking as it's falling. Usually a falling yield spread is bullish because the Fed's raising rates in the short end, but they're not. Those rates aren't necessarily rising on the long end. Now we do have to keep in mind that you can see the 10-year note. Kind of that longer term economic growth expected, that it actually fell today. The rates, these rates fell, and remember we talked about that head and shoulders pattern, and then a reflection of economic growth expectations. That's why I say the bond market's not necessarily saying that this is translating yet to actual market expectation. This is sentiment survey, a lot of it so far. It hasn't really translated yet to actual production, actual growth, and economic indicators. And the Fed, especially if that's really sentiment related, it's got to dampen that down, and that's why you see rate hikes rising. And you can see from a major asset class, we started the day with strong movement in the international stocks, and emerging markets finished today very strong. And that's been a recurring theme for the year. During the pullback, it was led, remember the 6 down days in a row that we had gaps to the downside? Well, all of those gaps to the downside were led by weakness in international stocks. They're starting to rally now and leading this risk. So make sure you're positioned accordingly. And there's a lot of the U.S. markets have been outperforming these international markets for years since 2009. So yeah, 1 year of outperformance by international stocks doesn't mean that now that move is over. There's potential that we could have some relative strength in international stocks over U.S. stocks for a while. So make sure that you're positioned in your portfolio to have that diversification. You can see the dollar was down today after being up yesterday. Dollar back down, and as a result, gold and the dollar bounce. You can see again, treasuries are up a little bit today. So prices. So again, the yields. These markets aren't necessarily saying, hey, economic growth is expected here. because again, the dollar would be outperforming its other currencies because of growth expectations being higher here than abroad. So we're not seeing that in the market. We are seeing that in the stock markets. They tend to be more bullish. They tend to be more anticipatory. Like, people anticipate good things. Stock market will usually show that kind of exuberance more than a bond market or the currency market. There's a lot more money, a lot more participants in those. So we'll kind of watch those markets to see whether or not the U.S. stocks here, this run that we've had over the past week, the strong bullish run, especially in small caps, will persist, or whether it's just kind of a quick bounce, very sentiment related, but not as, because we're so overbought, not able to sustain itself. You can see the big winners on the day, and will continue to be a big winner on any bull markets as technology. That's your momentum play. What's interesting is a value play has been healthcare. Healthcare has been really beaten up here, and it bounced up sharply today. Those are your two outliers to the upside. But that momentum continues to ride. The technology is at your momentum play. On the flip side of the coin, again, financials, financials don't like that spread falling. That's why financials is more of a leading sector, because it will kind of follow that spread. Even though the rest of the market's bullish, it can lag because it makes money from a wider spread more so than from a tighter spread. And again, not surprising to see the staples and utilities down and real estate underperforming on a bullish day. What is a little surprising to see the energy stocks not following the strength in crude oil. Crude oil is up 1%. Energy stocks, lagged and was the worst performing sector on the day. So that might tell you a little bit about this bounce in crude oil may be short-lived based on how the stock market's reacting to it. One stock showing strong growth on my screen here in that technology area and in the industry has been really killing it lately is that semiconductor. You can see how well Micron has been doing. It's almost up 100% here from August, close to $25 and getting close to 50. So strong run. In fact, just here recently, it's been on a strong bullish posture. We've pulled back to a near-term low point, higher near-term low, bounced off of that, got back up above 45. Strong, very similar to market. We have strong, we've had a multi-month. In fact, it's an almost exact copy of the market forecast. The intermediate line got above at the end of August, a little bit later than Micron did. Market sentiment's above, right there at 90, so it looks very close to what the market is. So again, it's bullish. It's a strong trend. We can take advantage of it. We have an earnings coming out here, and you can see earnings in the past. There's been a couple that have had initial weakness, but not significant to the downside. The two before that, very strong. So we say, okay, well, I don't want to be too aggressive here, and when earnings is like that, it doesn't mean I have to avoid it. It just means I have to trade smaller because of the increased risk that's out there. And we say, okay, what if I sold that 45? Because of that earnings, we get a little bit higher premium. I sold the 45 and bought the 43 for protection. That's where that resistance was that we broke above at the 45. You can see I'm getting about the credit that I need for a from a 30% return on risk standpoint. I'm getting about the credit we need, which is 47 cents on the $2 wide. So depending upon where we get filled in. When you throw it on the, when you throw it over here on the analyzed chart, the odds are pretty decent. Above just a little bit above 70%. Break even down below that 45 level. Again, this is based on current volatility levels, which are a little elevated because of that earnings. So keep that in mind. But there's a pretty decent way to say, again, I'm risk defined. So in case the earnings is crazy, I'm risk defined. I can trade smaller. And we also know, too, that, you're not going to lose that on the day of earnings. No matter, let's say we come all the way down here. When is that earnings announcement? It's on the 19th. So let's come over here on the Analyze tab and go. And let's see, by the 19th, we have... Right here is the week that includes the earnings on it. And so at the money right now is 275 plus 257. So you're looking at about a $5 and let's see, $5.50. So that's kind of what the market's expecting. So let's say it's a $5.50 move to the downside. So December 19th over here, 19th. we get a $5 move to the downside. So we'll 5.5. Let's get down to 44. Okay, so there's our move. Well, that's actually reset the parameters. Let's just move this price here to December 19th. Okay, so and let's go over here to 44. So again, this purple line is the profit and loss on the 19th, on December 19th. We drop all the way down to 44 bucks, and you can see we're not going to lose 150 bucks. We'll be down to $48 roughly. And you can see volatility will drop, but that's okay. It's, you know, we don't really care too much. We sold this. That's okay. So, but you can kind of see here that $49 loss. So you'll lose about half of, you know, well, a third of what you could lose in the kind of worst case scenario. And we're trying to get about 50 bucks. So now again, that can happen, and it could be worse than that. That's just theoretical. So we'll position size smaller than normal, but we have a really easy and kind of a less aggressive way to try to take advantage of the strong bullish trend and the outperforming sector and really good strong trend on this stock. So in summary, the market bounced up today. A lot of people probably, you know, trading today on expectations through the holiday. So don't be surprised if we grind tomorrow, we grind Friday, maybe even slightly higher according to past precedent, but nothing significant. And not surprising that we got all-time highs. Don't expect significant all-time highs coming out of this, and then heading into next week where traditionally has been a little bit of weakness that Monday after Thanksgiving. So we'll keep our eyes on that, see how weak that is. But as we saw today's strength, it's finally these other sectors kind of catching up to the strength we've seen in small caps from the tax reform anticipation, expectation that we're getting. It's impacting yields, the yield spreads. Are impacting the financial sector negatively, but while we're staying bullish, we've seen that technology sector continues to be a stalwart, leading the way higher. Maybe different industries here and there, but with the semiconductor industry showing some really good strength, very close to what the market's showing. So today's trade idea tries to take advantage of that. Thanks again for watching tonight. I really appreciate your time. Remember to subscribe, like, and comment down below on this YouTube channel. Also remember to follow me on Twitter for all the content I put out throughout the day, and to like and retweet the Market Outlook tweet from there. Have a great evening, everybody. We'll see you all tomorrow.